Today I've prepared a really exciting tutorial for you. We're going to be talking about indicators. So let's jump straight into it. So as you can remember, we talked about that the price has four main elements: the high, the low, the open, and the close. So indicators are basically aggregators of these values. So you have a stream of values of high, open, low, close coming into your terminal all the time. And what indicators do is they process these values to kind of give you a different perspective on the market. So let's have a look at a particular example. Here we've got a price chart, and say for instance we take the bar that's most to the right, and we take its high, and then we take its low, and we subtract the high from the low. Well, that difference is called the true range. It just basically indicates what the volatility or the amplitude of the market movement was for today. So that's good. So that's one of the things that you can derive from price, and that's an example of an indicator, because that value, the true range, is not actually given to you by default, but you can derive it from these two values. Next, let's take the true range for the next bar. And then let's take the true range for the bar after that. And then we'll take one more true range. So what we're going to do with all of these four true ranges is we'll take the average of these four true ranges. And that will give us the average true range in the past four bars. So that tells you not only how volatile the market was in the current day, but also how volatile the market was over the past 4 days on average. Because if you take one day, you can have an anomaly or some news might have come out, but when you average it out, it tends to smooth out the effects, and therefore you see a representative picture of the market. So what we can do now is we can plot this average true range on our chart. So let's make some space. We'll move up this chart a bit, and at the bottom we'll have a new chart. So let's plot this calculated average true range under the last bar. So this little blue cross at the bottom represents the average true range for the previous four bars. Next, we'll continue like that, and we'll take the average true range for the four bars before the current one. So excluding the current one, what's the average true range before that? We'll plot it as well. Let's do that again. Well, once more, we've got four bars, we've got the average true range plotted under the last of the four bars. We can do that again and again, and so on. We just keep going as far left as we want to, and we get all these little crosses at the bottom. So now what we're going to do is we're going to connect the crosses with a line, and that's what it looks like. So now what we've actually constructed is the average true range indicator with a period of 4. You can actually take this, find this indicator in MetaTrader 4 and drag it onto your chart, and you'll see exactly this picture. And sometimes traders, they're a bit scared of all these complicated indicators, and they kind of learn the names, they learn what they represent for the market, but they don't know the calculation. Well, this example shows that the calculations behind these indicators are very often very simple. In most cases, they're very simple. You just take the sum of the values from the open, low, high, and close, you do something with them, you take an average, and you plot it on the chart. So it's a very good idea to actually understand what's behind the indicators that you're using in your trading, and not only what they mean, but also how they're calculated. And so right now we know that this average true range indicator tells us how volatile the market has been over the past 4 days. And to finish off today's tutorial, let's have a quick look at the average true range on a real chart in MetaTrader 4. So here's a chart, a snapshot from MetaTrader 4, and at the bottom you've got the average true range with a period of 14. That means that every single element in the average true range represents the smoothed out true range of the past 14 bars. And that's how it's been changing, and that tells you of the market volatility. So right now you can see on the right, the true range is somewhere about average, meaning the market is not in its most volatile time. And you can use that in your trading. So maybe your trading strategy tells you that you are trying to avoid volatile times because they're more, they bring more uncertainty, and you want to trade during less volatile times. or maybe you want to trade during more volatile times and take big movements and big impulses. So there's lots of indicators on the Forex market. They're all constructed differently. Have a look around. You'll definitely find some that you like, some that you don't like. In our trading, the one we will focus on is the moving average. So personally, I think the moving average is a very powerful indicator. It's very simple, and in Forex, very often simplicity is the key to your success. If you overcomplicate things, then you might miss out on the obvious. So today we're going to talk about moving average. We'll see how it's constructed, and then we'll see a few examples of how to use it in trading strategies, and I'll just give you a few more thoughts on this indicator. All right, so similar to what we did in this past tutorial with the average true range indicator, let's have a look at how the moving average is constructed. So if we take the past 4 bars and we take the close prices of these bars, and then we plot the average of them, it'll look something like this. Next, if we move to 1 bar to the left and we take the average of the 4 bars there, then we plot it, it'll look something like this. Then if we keep going and keep plotting the average every time, we can keep going as far as we want left and we'll get a picture like this. Next, we'll connect all these points on our chart with a line and get rid of the crosses. So that's how your moving average indicator looks, and this particular moving average has a period of 4, and that's because of the way we constructed it. We're looking at 4 bars every time. This case is a bit different to the average to range because we don't have to plot this indicator in a separate chart. And you'll notice that on the Forex market and in MetaTrader 4, there are 2 types of indicators. Those that are plotted on the same chart as the price, and those that are plotted in a separate chart. Now in this particular instance, we didn't have to plot it separately because the actual range in which the indicator has its values is actually the same of the chart, as of the chart. So what we're taking is we're taking the average of the past 4 prices, so it will be somewhere there on the chart. Whereas with the average true range indicator, we're taking the difference of the high and the low. So obviously if your high is 1.5 and your low is 1.4, then the difference is 0.1. It's not going to be anywhere near the current values on the chart, so it will be very far down, so you have to kind of plot it on a separate chart. So that's our moving average. Let's have a look at the moving average on a real Forex chart. So that's our euro-dollar hourly time frame chart, and as you can see here, I've plotted the moving average with a period of 48. So in this case, it means that every single value of the moving average represents the average close price for the past 48 bars. And because this is a 1 hourly time frame, 48 means 2 days, so 2 times 24. So it basically means the average close price on the hourly time frame for the past 2 days. And that's how it's been changing. You can see that it went first down, the average, then it started picking up, and then it started going down again. So how can you use the moving average in your trading? There are several methods of using the moving average, but we'll look at the 2 main ones and the 2 most simple, straightforward, and most frequently used methods. So the first one is using the moving average as a signal generator. Let's have a look at the chart again. Can you see here that when on the left the price crosses the moving average downwards, it keeps going down? So in that case, when the price crossed the moving average down, you would sell, expecting the price to keep going down. And then when the price crossed the moving average upwards, it kept going that way. So you could buy here, expecting that it would keep going that way. And then once again, when it crossed down, you could sell, expecting that the price would go down. So as you can see, in times when there's a trend on the market, if the price is below the moving average, then it's a downward trend. If the price is above the moving average, then it's an upward trend. So this strategy works during trend times. Unfortunately, it doesn't work during flat times, like when there's no movement on the market, because the price tends to be very close to the moving average and they can cross over very frequently. So you have to be careful when you use this strategy, but do keep in mind that if you see the price above the moving average, then most likely you are currently in an upward trend. Next, the other way of using the moving average is using it as a support or resistance line. And this is actually very interesting. You will notice that our support resistance line were either trend lines or levels, and that's what we talked about previously. But now we've got a moving support and resistance line, so let's have a look at that. We've got the moving average here, the same one as we talked about. Can you see how on the right, during the uptrend, the price actually bounced off the moving average one time, the second time, and the third time? So that's not a coincidence. That is quite a frequent phenomenon on the Forex market. And if you find, you have to kind of pick the right period for your moving average, which we'll talk about in a minute. But if you pick the right one for the right situation, you can actually effectively construct a moving support or resistance line, which is very powerful. And there are many different speculations why this works. And for example, one of them is because other traders also use the moving average, and when a lot of traders and decision makers for large funds use the same strategy, it tends to work. And in this case, they see the price approaching the moving average, and they know that it's going to act as a support line, so they kind of buy, and then they buy again, and they buy again every time that happens. So this strategy may work for that reason. But regardless of why exactly it works, it's a good thing to look out for. And moreover, in our live trading on a real Forex account further in this course, you will see us use this strategy to our advantage to make profits. And I'll explain exactly how I pick the right period for the moving average and how to better use it in your live trading. And finally, the last remark I wanted to make in this tutorial was that the period of the moving average is very important. Let's have a look at the chart again. So this is the moving average with a period of 48. If you plot the moving average with a period of 12, that's how it will look like. And if you plot a moving average with a period of 150, that's how it will look like. So as you can see, all of them are very different, and they can give you different insights into the market and actually different recommendations to what you have to do. So it's up to you as the trader to pick the right moving average for your currency pair, for your time frame, and for your particular situation. Don't worry, it might sound complicated, but in reality it's very simple, and with time you will get the hang of it, and with every single situation you'll get better and better at picking the right period of the moving average. Forex robots. So in MetaTrader 4, Forex robots are also called expert advisors, and the whole topic that we're talking about in today's tutorial is called algorithmic trading. So what is it? What is algorithmic trading, and what are these Forex robots? So a Forex robot can be envisaged as an actual robot, but in reality it's a program. It's like a computer program which can work through MetaTrader 4. Some programs work without MetaTrader 4, and the concept behind it is that if you launch this program on a Forex chart, it's supposed to bring you profits automatically. So you basically just set some inputs for the program, and you let it run, and it'll just earn you money in the background. So let's talk about this for a second. A lot of traders think this is a hoax, this is not possible, this is, the dream of any investor, that you just do nothing and the money is earned in the background. And to some extent, it is true. It's not entirely possible to just have money coming into your trading account all the time with no effort at all. And there are a lot of scams out there on the market, just in the internet, that will tell you buy this Forex robot and it'll earn you money and you'll be rich and you'll never have to worry about trading again. So 90% or 95% of the stuff you see on the internet are scams. They're just trying to get your money as quickly as possible before their system starts to fail. But the truth is that algorithmic trading is actually possible, and it does work. And I'm a live example of that. I'm a live example of a success that I've had in algorithmic trading. Most of my trading, like people sometimes ask me, like, what strategies do you use, and like how often do you trade and things like that. But most of my trading strategies are actually all have all been converted into Forex robots. And I have made tens of thousands of dollars just using Forex robots, and actually I try to stay away from manual trading because of the convenience that trading with Forex robots brings, which we'll talk about in a minute. But I just wanted to emphasize that trading with robots is possible. It does bring you money, and it has massive advantages when you're actually into it, when you know what you're doing. It's not effortless. It's not just switch it on and go away. It does require maintenance. It requires certain inputs from the trader, certain decisions, which robots to put on, which ones to take off, and re-optimization and things like that. But the bottom line is it's possible and it's highly advantageous. So some of the advantages that algorithmic trading brings to you as opposed to, or when compared to manual trading, well, the first one, of course, is you get the freedom of time. Like Forex, the Forex market does give you financial freedom in terms of if you master it, you won't have to go to work anymore and you can trade from any place on the planet. But it doesn't give you freedom of time. You still have to follow your trading strategy, you still have to watch the charts, you still, even at least a couple of hours a day, you will have to sit in front of your computer and make decisions. Whereas when you turn your trading strategy into a Forex robot, you can set it on your chart and just let it run in the background while you sleep, while you have fun with friends and family. And you just have to check up on it once a week or, several times a week. But generally, it frees up the constraints that you may experience when your trading strategy requires you to be in front of the computer. And for me, that's a massive advantage. And like I even took it to the next level through setting up a virtual private server where my Forex robots run. So I don't even have to use my home computer. So it's just sitting somewhere in a different country and the Forex robots are running, and I can just check on it once every couple of weeks even and see that everything's going all right. The second massive advantage of algorithmic trading, which can for some people be even more important than the first one, is the psychological side of things. That when you're trading with your own hands and with your own mindset, you have to make certain decisions and you have to watch the market and see your profits and losses, and that can be can have a massive toll on your emotional state, and it can devastate you when you see a loss, or it can even being happy about a profit. You see, that's a good thing. Maybe you might think it is, but in reality, it's not. Forex should be cold-blooded. Ideally, you shouldn't be happy about profits, because if you're happy about profits, you're going to be devastated when you see losses. Everything should be calculated, and you'll see that in our section on live real trading, that our risks will be very diligently calculated, and we will know exactly how much we are risking to lose and things like that, so that when the time comes to open a trade, you're not emotionally involved, and that's very important with Forex trading. So what Forex robots allow you to do is they take out the emotional side of things completely. Because it's a robot trading for you, and because you don't even look at the market, all you're relying on is that your trading strategy is correct. You've come up with a good trading strategy, and it's just going to bring you money in the long run. So even if you have 5 profits and 1 loss, then you're generally making more money than you're losing. Then you'll have profits, so you don't have to worry about the losses and be happy about the profitable trades individually. You just look at the big picture when you have Forex robot. So those are the two main game-changing advantages that Forex robots bring. It's not to say that manual trading is not a great option, is not something that you want to pursue. Definitely, you have to start with manual trading, and some people just stay manual traders because they get passionate about it and they love what they're doing and they genuinely enjoy trading the charts. However, just keep in mind that there is this option of trading with Forex robots, and maybe you might want to check it out at some point through your Forex trading journey.